Have you ever wondered how to grow your wealth with dividend stocks? The world of investing can seem like a labyrinth, but one path that has proven to be fruitful time and again is investing in dividend growth stocks. These are the stocks of companies that have a track record of consistently increasing their dividend payouts. Why is this so significant? Well, the answer lies in the magic of the dividend snowball effect. This effect is the compounding growth in dividend income that occurs when you reinvest your dividends and continually add new capital to your investments. Over time, these reinvested dividends start to earn dividends of their own, causing your income to grow exponentially. It's like a snowball rolling downhill, gathering more snow in size as it goes. So, if you're seeking a smart and sustainable way to grow your wealth, dividend growth stocks might be your answer. With that in mind, we delve into our first company, Johnson & Johnson. Johnson & Johnson recently increased its dividend by 3.32%, reaching $1.24 per share. This increase is a testament to the company's commitment to consistently reward its shareholders. Notably, Johnson & Johnson currently offers a higher than normal starting dividend yield of 3.32%. This elevated yield is partially due to a decline in the company's share price. Johnson & Johnson has a remarkable track record when it comes to dividends. For over 50 years, the company has been steadily increasing its dividend payouts, earning it the prestigious title of a dividend king. This long-standing history speaks volumes about the company's financial stability and its ability to weather economic storms. But it's not all sunshine and rainbows. There are some concerns worth noting. One of them is the rising free cash flow payout ratio. Over the past few years, the company's free cash flow growth has been slower compared to its dividend growth. This has resulted in an increase in the free cash flow payout ratio, which is a potential red flag. The free cash flow payout ratio is a critical metric for dividend investors. It measures the percentage of free cash flow that is used to pay dividends. A higher ratio may indicate that the company is distributing more money to shareholders than it is generating, which could be unsustainable in the long run. However, it's important to put this into perspective. Johnson & Johnson is a large, diversified company with a stable cash flow. It operates in the healthcare sector, which is generally considered to be recession-proof. People will always need healthcare products and services, regardless of the state of the economy. This gives Johnson & Johnson a certain level of resilience and predictability in its cash flow. Furthermore, Johnson & Johnson has a strong balance sheet and a solid credit rating, which provides it with financial flexibility. The company also has a history of making strategic acquisitions and investments to fuel its growth and diversify its revenue streams. That said, the rising free cash flow payout ratio is something that investors should keep an eye on. It's crucial to monitor the company's cash flow growth and ensure that it can comfortably cover its dividend payments. In conclusion, despite some concerns, Johnson & Johnson remains a solid dividend growth stock. Its long history of dividend increases, combined with its resilient business model and financial strength, make it a compelling pick for dividend investors. So, while it's important to be aware of potential risks, Johnson & Johnson's track record and future prospects cannot be ignored. Now, let's move on to Apple. Apple recently announced a 4.2% increase in its dividend, bringing it to 25 cents per share. This might not sound like much, but it's important to remember that dividends are just one piece of the puzzle when it comes to evaluating a company's financial health and potential for growth. In the case of Apple, there are several factors that make this modest dividend increase quite significant. For one, Apple is known for its conservative approach to dividends. The company has a relatively low starting dividend yield, currently sitting at around 0.55%. This might seem low, but the silver lining is that Apple's payout ratios are also very low. This means that the company is retaining a large portion of its earnings, which it can then reinvest into its business for further growth. But that's not all. Apple also recently announced a significant stock buyback program of up to $110 billion. This is a huge move that indicates the company's confidence in its future prospects. By buying back its own shares, Apple is effectively reducing the number of shares in circulation. This increases the value of the remaining shares, benefiting current shareholders. And what makes this massive buyback feasible? The answer lies in Apple's substantial cash reserves and its strong free cash flow. Apple is one of the wealthiest companies in the world, with a cash pile that's the envy of many nations. This financial strength not only allows the company to fund its stock buyback, but also provides it with a safety net in case of unexpected downturns or market volatility. Moreover, free cash flow, which is the cash a company generates after accounting for capital expenditures, is a key indicator of a company's financial health. And in Apple's case, its free cash flow is robust and healthy. This is a positive sign as it means that the company is generating more than enough cash to cover its operations, invest in growth, and still have plenty left over to return to shareholders through dividends and buybacks. So what does all this mean for investors? Well, when it comes to dividend growth stocks, Apple may not be the first name that comes to mind due to its low starting yield. However, when you factor in the company's consistent dividend increases, its massive stock buyback, and its strong financial health underscored by substantial cash reserves and strong free cash flow, it's clear that Apple is a force to be reckoned with. In a nutshell, Apple's strategy of steadily increasing dividends combined with its buyback program and strong financial health makes it an attractive option for investors seeking stable growth and potential for future dividend increases. It's a testament to the company's commitment to delivering shareholder value and a shining example of why dividend growth investing can be a smart strategy. Apple's consistent dividend increases and strong financial health make it a standout. Now on to Pool Corporation. Pool Corporation recently increased its dividend payout by 9.1%. Now let's dive into the deep end and take a closer look at Pool Corporation, or Pool. This company, like a well-maintained swimming pool, is filled to the brim with potential. And we're not just talking about a kiddie pool here, we're talking Olympic-sized. Pool's dividend growth is nothing short of impressive. Over the past decade, the company has demonstrated a compound annual growth rate, or CAGR, of 18% in its dividend. That's like having a high-powered pool pump continuously circulating and refreshing your investing waters. But the company's not just making waves with its dividends. Pool's free cash flow growth is equally impressive, boasting a 10-year CAGR of 25.37%. Imagine that as a high-dive platform propelling the company's financial health into the stratosphere. And speaking of financial health, let's talk about the free cash flow payout ratio. For those unfamiliar, this is the proportion of free cash flow that a company pays out as dividends. It's a key indicator of a company's ability to sustain its dividend payments. In the case of Pool, despite its high dividend growth, the free cash flow payout ratio has actually decreased. This is a positive sign, indicating that the company is generating enough cash flow to comfortably cover its dividend payments. It's like having a lifeguard on duty, ensuring that your dividends are safe and secure. But let's not forget about the starting dividend yield. At 1.21%, it might seem on the low side, especially compared to some other companies. But remember, we're focused on growth here. And in the world of growing dividends, it's not about how deep the pool is to start with, it's about how much it's filling up over time. In the case of Pool, the consistent and robust dividend growth, combined with the strong free cash flow growth, is filling up that pool at an impressive rate. It's like having a powerful pool heater, steadily raising the temperature of your investment returns. So, whether you're a seasoned swimmer or just dipping your toes in the investing waters, Pool is worth a look. Its solid growth and strong financial health make it a promising prospect in the world of dividend growth stocks. It's like finding a clean, well-maintained pool on a hot summer day, refreshing, inviting, and full of potential. Pool Corporation's impressive dividend and free cash flow growth make it a promising dividend growth stock. Now let's look at Dick's Sporting Goods. Dick's Sporting Goods recently announced a 10% dividend increase. Now let's delve into why this is a significant move for the company. Dick's Sporting Goods is a leading omni-channel sporting goods retailer, offering an extensive assortment of high-quality sports equipment, apparel, footwear, and accessories. Over the past year, the company has shown remarkable performance with a 42.21% increase in stock price. This is a testament to the company's strategy and execution, which have resulted in consistent growth and profitability. Let's talk about dividends. The company's starting dividend yield stands at 2.17%. Which is quite competitive in the current market environment. But what sets Dick's Sporting Goods apart is not just its regular dividends, but its occasional special dividend payments. These special dividends significantly boost shareholder returns, making the company an attractive investment for those seeking regular income alongside potential capital appreciation. But dividends are just one part of the story. The company's financial health is another critical factor that investors should consider. And Dick's Sporting Goods doesn't disappoint in this regard. The company has shown strong free cash flow growth, which is a positive sign since free cash flow is the cash a company generates after accounting for capital expenditures. This cash can be used for business expansion, dividend payments, debt reduction, or even share buybacks. Moreover, the company has consistently increased its revenue and earnings per share. Consistent revenue growth shows that the company's business is thriving and that it's successfully attracting and retaining customers. On the other hand, steady growth in earnings per share indicates that the company is effectively managing its costs and improving its profitability. In the world of investing, consistency is key, and Dick's Sporting Goods has demonstrated this consistency in its performance, dividends, and financial health. This consistency, coupled with the company's strong business fundamentals, makes Dick's Sporting Goods a compelling investment for dividend growth investors. But as with any investment, it's important to do your own research and consider your financial goals and risk tolerance before investing. And if you're considering investing in Dick's Sporting Goods, it's worth noting that the company operates in a competitive industry and faces risks such as economic downturns and changes in consumer preferences. To wrap it up, Dick's Sporting Goods' recent 10% dividend increase is a positive development for the company and its shareholders. It reflects the company's strong performance and financial health, and it enhances the appeal of the company's stock for dividend growth investors. Dick's Sporting Goods' strong performance and consistent dividend increases make it a compelling dividend growth stock. So, if you're looking for a stock that offers a competitive dividend yield, special dividends, and the potential for capital appreciation, Dick's Sporting Goods might be worth adding to your watch list. Investing in quality dividend growth stocks can be a powerful strategy for wealth creation. As we've explored throughout this discussion, the power of dividend growth investing rests not just in the immediate payouts, but also in the potential for long-term wealth generation. The dividend snowball effect, the phenomenon where reinvested dividends and additional capital contribute to the compounding growth of dividend income, can be a potent force in your investment strategy. Let's recap what we've learned about the four companies we've analyzed. Johnson & Johnson, a long-standing dividend king, recently increased its dividend by 3.32%. Despite concerns about its rising free cash flow payout ratio, it's a company with a proven record of consistent dividend growth. Apple, on the other hand, offers a modest starting yield but shows promise with its consistent dividend increases and impressive stock buyback program. Its substantial cash reserves and strong free cash flow position it as a robust player in the dividend growth arena. The Pool Corporation has shown impressive dividend and free cash flow growth, with a 10-year dividend CAGR of 18% and a free cash flow CAGR of 25.37%. Despite its high dividend growth, it has managed to decrease its free cash flow payout ratio, indicating strong financial health. Finally, Dick's Sporting Goods, with its recent 10% dividend increase and strong performance in the past year, adds a special flavor to its dividends by occasionally issuing special dividend payments. These companies illuminate the opportunities available in dividend growth investing. By focusing on quality companies with a history of consistent dividend growth, you can build a portfolio that not only provides regular income but also grows over time. Remember, the key to successful investing lies in selecting quality companies and having the patience to let your investments grow over time. We hope you found this video enlightening and that it has helped you better understand the power of dividend growth investing. If you did, we would love to hear from you. Please leave a comment below sharing your thoughts or any questions you may have. Your feedback helps us create better, more informative content. If you found this video helpful, please hit the like button. It lets us know that we're on the right track and helps others discover our content. And don't forget to subscribe to our channel. By subscribing, you'll get notified every time we post a new video, ensuring you never miss out on important insights and investment strategies. Remember, investing is not just about making money, but also about growing and learning together as a community. Thank you for your support and for being a part of our investing community.